Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending Feb 26, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is the Canary singing. Let's talk a little bit about the wild, wacky week that we just had and just kind of a little bit of my insight on what I believe we can see coming up. Now, let's take a look at the markets and just kind of see how things are shaping themselves out here. So if we look at it, we can see on the index performance level, I'm going to put this up on the box here. You can see everybody was in the red for the week. Dow, S&P, Nasdaq, Russell, all down. Nasdaq got hit very hard. Year to date, we're still in the green across all indexes in the US. You can see the PE ratio, the forward PE ratio, 22.47, still very high historically. Dividend yield, notice the dividend yield is at 1.50% and the Treasury yield is at 1.46. Spread is 4 basis points. We actually had a point where we've been typically seeing the 10-year Treasury yield much lower, but we did have a point this week when the 10-year Treasury yield actually went over the S&P dividend yield. It backed off just a little bit. But the spread is only 4 basis points. That continues to encourage more money flow into the fixed income market. Remember, money always goes where it's treated best. And the higher the interest rates run in the 10-year, 30-year, and so forth in the Treasury market, is going to start competing with equities for money. You can see volatility also up almost 40% for the week. Last week it closed at 19.97, so right around 20. Kind of has been the floor for volatility for a number of months. But this past week into Friday's close, the VIX closed at 27.95, so it was up almost 40% for the week. Now look at the sector performance. This past week, energy continues to just knock the ball out of the park, up 4.07%. Year to date, look at energy and oil, 25.58%. That is clearly part of the inflationary factors that we can see coming. The worst performer for the week, of course, is utilities. As always, whenever you have utility sector is like the bond proxy in the equity market. So generally when bonds go lower, you're going to see utilities go lower too. So it really underperformed this week, a whopping 5.19%. And it also caught up and surpassed staples to be the worst annual performer thus far through most of February going into the third month of the quarter. It's down, utilities down 8.39%. Now, if we look at the markets here and just kind of, take a look at where we were, take a look at some of the index performance, we saw that weekly jobless claims hit some of their lowest levels, 730,000 in the past 3 months. It recorded the biggest decline since August of last year. Personal income, meanwhile, coming in this Friday, jumped 10.1% in January, largely from payments from the coronavirus relief package passed in December. But it's the largest gain since April of last year. That was coming right out of the COVID crisis. And the manufacturing sector still remains in very solid shape with core capital good orders rising 50 basis points. So all of this is contributing to money in pockets, money being spent, people getting back to work. So that tends to obviously jigger a little bit inflation worries. And speaking of inflation worries, if you look at the U.S. Treasury market, you can see that there was a stronger than expected economic data, as I just talked about. Technical factors this past week really goose the interest rates in the bond markets around. We had a very weak auction on Wednesday. The bid to cover was horrible. And it forced really, which tells me that the Feds weren't at the auction table to buy and letting just capital markets come in and buy. It forced interest rates up very quickly. It kind of spooked the markets a little bit. It pushed the 10-year Treasury up on Thursday to 1.61% before it fell back to the 1.46% to close out the week. But that just shows you guys what can happen. And on the other side of the ledger, you saw what happened with equities. We were down a pretty good bit with that spook in the interest rate in the bond market. Investment grade bonds also, their spreads widened a little bit with rising rates, but we had some pretty good inflows into the corporate bond market, and pretty good volume, so it didn't really get too crazy. Okay, but there was a spook this past week, and it shows what can and will happen when this starts to surface again. And I promise you that we're going to see this again. And then, of course, over in Europe, we can see that. Let me just get. We got UK Prime Minister Boris Bulldog Johnson. He unveiled plans for gradually lifting lockdown restrictions in England. They've had one of the toughest. And in Q4, German GDP was revised higher. Okay, let me just get some charts up here for you for the rest of the world indexes. And also, we see the Eurozone economic sentiment indicator also rose in February from the month earlier. It's the highest it's been since last March. Okay, so we're starting to get some positive data out, but this week, those rising interest rate yields globally just crushed everything. Look at the weekly performance. The Euro Stocks 50, which are the 50 largest companies across Europe, down a little over 2%. Year to date, it's in the green. But the FTSE and the CAC 40 in the red, not only weekly, but year to date. The bad performance is just dragging them down. The DAX, the Nikkei, German index DAX down 1.48%. It's about flat year to date. Look at the Nikkei, down 3.5% for the week. It's still up a robust 5.5%. China had a horrible week, and Hang Seng too. Over in Hong Kong, they were looking at taxing or going to tax stock market transactions, and that just killed the Hang Seng market in Hong Kong. Still up strong year to date, but it just by and large, it was fairly ugly. Right? Just really not much to talk about. And then the other thing in China, they're going to consider changing how their citizens there can invest in overseas assets. Right now, every Chinese citizen, unless of course you're tied to the government, you're one of those elite idiots over there, they can do pretty much whatever they want as long as it's approved by the CCP. But they can purchase foreign currencies up to about 50,000 annually, and they use it for overseas travel, study, work, that kind of thing, unless it's supported by the CCP. But they're going to change the rules to allow not only purchasing currencies, but they're going to allow them to buy overseas assets, right? Overseas securities, insurance policies, that kind of thing. So they're going to expand it a little bit, and we're going to see how that plays itself out. Meanwhile, coming up in early March, we're going to see the National People's Congress. And have you ever noticed every communist country names everything the People's Bank, the People's Party? And trust me, guys, there is nothing about the common people or the people that have to do with it, but it's just a communist thing. You can kind of see that trying to come here. Everything that libtards and others do, they want to do it for the people, but it has nothing to do with the people, right? But anyway, that's an aside. Anyway, the Chinese investors are going to be focusing on the National People's Congress, that starts on March 5th. That's typically when these 400 old dudes that run the CCP and all of communist China, they're going to be reviewing, the past year's performance. The annual parliamentary meeting is going to offer a roadmap for the future economic plans, including goals for this year, and their 5-year development plan. So that always proves to be a hoot. We're going to see how that plays itself out, right? So now if we just switch over and take a look at the charts here, what I'm going to do is I'm going to flip the screen here, and it's going to take a couple of seconds to rebroadcast the screen here. Let me just come over here and do this. And I'm going to show you we're going to look at the E-mini S&P 500 240-minute futures, 240-minute bar futures. Okay, so that you guys can see that. Just kind of take a look and see how price action goes. And it's a really good time frame to use. It's kind of like looking at the looking glass of a daily, right? It really does work itself out really well. So looking at the chart here, you can see on this 240-minute, we've come down. We're hitting some key fib levels here. These key fib levels were established on the pivot lows made late January going into February, and then the recent all-time highs that we made on 15th of February. The first 2 weeks of February were very strong, and now we're just giving up a percentage of that. We're sitting right now at that 50% node at 38.06. All right. And you can see here the closing price of 2020. This is the dividing line, this blue line here between being in the red and being in the green for the year. You can just see this. And I was telling our members we have to watch out for a bull trap. And that's exactly what we had here. You know, we came all the way down. We tested that level. We came all the way back up. And I said, until we can clear this level right here. And I had originally said the 38.98, or let's just call it the 3900 level, said I wanted to clear it and then it's got to hold. We got up here, but we could not take out that prior pivot high right here. And then we just came right back down. We gave up to 3900 and then away we went. You can see we came down and not only tested with these lows here, the prior pivot low, but we made a lower low. In fact, we even closed right on that line right there, right? So the only good news out of all this is we managed to close at 38.07 for the week, but we took out, as I said, that prior pivot low. So that is not a good sign. And you want to mark your charts with prior pivot highs and prior pivot lows to see if there's a change in polarity. And by not making new pivot highs and making new pivot lows, then that's not a good thing. We could say this is a lower pivot high than that prior high there, than that, high there, right? And then we can say this is a lower pivot low from this prior pivot low. So as long as, and it's the definition of a trend, but you need at least two of these to start to define a trend. And then the more you have, the better you're going to get. The other thing is the difference between this level right here and this level right here. Notice we got a cross here and we haven't even crossed yet here. So we got a lower low there. So that suggests that any run up, we're going to get another bull trap kind of thing and we're going to come back down again. And not until, in my mind, we can take out the 3900, hold that level and move up and take out that level there, 3936.75. And if that happens, I believe 3900 will hold, and then we'll come up and we'll hit an initial short-term target here of around 4,000. Okay. So remember what I've been saying in these weekly roundups. I've been saying we're going to have anywhere from a 10% roughly to a 15% pullback. And that would be actually very healthy for the markets. And I said when this does happen, you can watch the gurus on TV start to say that's the end of the bull market, all hell is breaking loose, blah, blah, blah. Don't believe that. I'm looking for a good solid pullback. And then after that pullback, then we want to load up because I do believe we're going to have a strong finish to the year. So for members, I'll go through in detail and then I'll hike it out to you in our chat room when I believe it's time to just start loading up again. Right now, we're defensive. We're in that pullback mode. Now, I was calling a pullback starting in December. I said in Q1, we should get a 10% to 15% pullback sometime in Q1. And because we finish year and going into January fairly strong until the second week of January when we had that 3.4% pullback, we've had 7 pullbacks since the March lows of last year of a little over 7.4%, I think is the average. So if we had a greater than 7% pullback, we would be hitting the average pullback since March of last year. And I know it doesn't seem like we've had 7 of them, but we have. A lot of them were back end loaded last summer when the markets were extremely volatile. And lately, every pullback has been rapidly bought. But I do believe we're going to be in store for some. I'm going to switch the screen right now over. Let's just take you to a daily chart because I've got other charts set up that I want to show you that are really important to price action here. So I'm going to take you back. We're going to stick with the S&P 500 E-mini futures, but it's a daily chart. And you can see here on this screen, we came right down. The red line is a 50 moving average, 50 EMA. We're holding that. And you could see right over here back in January, the end of January, now it doesn't look like it, we pulled back about 3.4%. And that's when we came close to testing our lows for 2021. Our lows for 2021 were actually made on January 4th. And we have not come back and hit that low, but we challenged it back here on the beginning of February. And then we've just had this huge run up here. And now we're coming back here. So this is like an ABC pattern. And what we've got to check on here is just look at the strength of this thing. So if you've got an A leg, a B leg, and then maybe a C leg, and then after that, we're going to rocket higher and more of a 5-leg pattern back up, hitting, well north of that 4,000 level, maybe 4,100 or so. I do believe by the end of this year, we'll be anywhere from 41 to 4,300. Now, that's just an estimate right now based on the way the chart patterns are looking, but that can always change depending on the nature of this dip, whether it becomes a bigger dip or a big pullback or an official correction, which should be over 10%. Okay. So right now we're holding, but should this break, I would not be surprised to see a quick test of the 2021 lows at 36.52, right? Now, just to give you an idea of how far that really is not much, guys. I think everybody's gotten comfortable with these pullbacks. But if I were to come in here and let me just highlight that on the screen, and if we just measure it, right? Let's just come back up here and measure. If we come back and hit the 2021 lows, that's 7.6%. So that would be, we've had 7 pullbacks since March of last year with the pandemic. Bottoms or the lows. The average pullback's been about 7.4%. So if we hit the lows that we made on 4 January of this year, that would give us about a 7.5, 7.6 pullback. A 10% pullback takes us all the way down right around this level here, around 35.50. I would like to see that. If we come down to the 200 EMA, remember it's moving up just a little bit, but that would give us about 11.4% pullback. And that would flush out a lot of weak hands. And then I promise you'd see money coming into the markets. You can also see here that there's no divergence here. So that does suggest that any pullback is probably going to be bought. And this initial leg lower, we're probably going to have another little bit of a bull trap. Now I showed you that bull trap on the 4-hour. We'll probably get a bull trap here on this daily, a little bit of a lift higher and then a roll back over again. But when it's all said and done, we're going to want to load up, folks. We're just going to want to take it and run with it. So that's a little bit about what I'm seeing. And then, of course, if we look at the Russell has been the one that's been leading the pack. Okay. And if we look at the Russell index, you can see that we did not quite make, we made a lower high here. We're well north of the 50 EMA. So that would be the first test we're going to get, well north of 2020. Because as I said, the Russell year to date is up 11.28% right now. Okay. No divergences in the MACD. So I think we could get a lift up and then maybe another rollover. And then we'll round that out. We'll come out of January. January is going to be kind of a choppy, crazy month. And then going into April, May, it's going to start to strengthen up. Remember, we got the vote on the stimulus bill. I don't think we're going to get the 1.9 million or trillion, but I don't think the market's going to be too upset with that. I think 1.9 trillion is not needed. I would prefer a more targeted bill to the people that really got whacked. But, politicians just can't not spend money. That's just what's in their DNA. I hope they're a little bit wiser than that, but so far I haven't seen any of that. So that's kind of what we're looking at here. But remember, small cap and mid cap typically lead the markets higher at the beginning of a new economic cycle and or in early stages of a bull market. And you can argue that they were in the early stages of a bull market because we had an official bear market last March. Granted, it was the shortest bear market on record. We pulled back and went into a bear market in less than 3 weeks, and we pulled back out of it again in another 3 weeks. It was crazy, 3 or 4 weeks. So it was the shortest bear market on record, I believe, and there was nothing normal about it. Most bear markets last anywhere from a year to a year and a half, and when you get things that last 6 weeks, You can almost discount it. But some market tacticians are counting that as a new reset. But we are seeing that in the small cap and mid cap. They're just leading the way higher. The Russell is completely outperforming. For our members tomorrow evening, I'll go through some great ways to play that, as some of the trades that we're running are just kicking butt right now. Okay. If we look at volatility, you can see right here with the VIX. Look at the VIX here. It started moving up on the 12th of February, and it's just been moving up and up and up. We actually, on Thursday, we hit a high note of 31.16. We actually moved back up above 30. Notice here, if I step it out just a little bit, how we cannot seem to get, we've got this support area right here, and for whatever reason, volatility is staying bid, and we're hitting all-time highs in the market with the market staying bid. So there's something the markets are concerned about, and I suspect it has to do with interest rates, and are we going to get inflation or are we not going to get inflation? Okay. And so we got to, and I have always been, as you members of our user group know, we follow the credit markets very closely. The credit markets are our canary in the coal mine. Okay, and that's how farmers a long time ago used to see if there was methane gas being pumped out of these mines, because you can't smell it. But the canaries were the first ones that were affected, and they just peel over and crap out and die in the cage, right? So that's why I said, are the canaries singing or are they going to be rolling over? We got to follow the credit market. So most of our members in our user group know that we follow these credit markets very closely, because it controls where the equity markets go, not the other way around. You want to follow it. So we're going to be looking at the yield curve, the spreads, and what's going on in these markets. And you're going to see just how much of an effect it does have. You can look at bonds on Friday. We had a really horrible reaction in the credit markets on Thursday, and then Friday it came right back again. I mean, we moved over two handles. That's over $2,000 in the futures market with bonds. But as you guys know, it's a low-hanging fruit trade way back over here. I said you got to short the bond market every time it comes up and kisses the 50 EMA. And it's just been a home run trade for us, right? We've got members that are playing this thing and making a killing. Remember, it's $1,000 a point as we move lower in the futures market. Or you can trade TLT, that's just as good, right? And you could size this thing, position size it based on your risk parameters. But it's been a really good trade. And we had the 50 cross the 200 back in December of last year, and we were already short this thing well before then, right? It was a low-hanging fruit trade. If we look at the 10-year interest rates, it's going in the other direction. Look at this thing. I mean, look at what happened. Now, we did have that spike in interest rates on the 25th, and it went up to 1.614. Huge. And then it came right back down, but we're still up here. And this is all on the idea that interest rates are going to be moving higher. And I don't care what Boom Boom Powell says, and he had a conference, or he was speaking this past week on Wednesday, and he said that he confirmed their dovish stance in his testimony in front of Congress, and he said inflation is going to be soft. I don't believe it, right? I remember very closely about a December or so ago, he said it's a transitory, he used the word transitory, and it wasn't transitory, it was permanent, and he totally crashed the markets in December. I think it was 2017 going into 2018, and then he just came out and said, okay, my bad. I think the minute they start changing their policy stance, you're going to see equity markets react very ugly. And there are a number of ways that they could do this, not just by raising interest rates if inflation comes in. They can cut their QE. And I think the first thing they're going to try and do is do what they did back in 2013, 14, or 15 when they did Operation Twist. Members, we'll go into that in more detail. But once we start seeing this, and it's going to help guide us as far as our equity trades go. Okay. And of course, if we look at currencies, low-hanging fruit trade there, I'm not going to go into the detail, but look at the dollar, really moved up very strong. And we came right down to a 20, it really should say 2020 close. But you can see here, moved up very strong. I think the dollar is going to surprise people. It shows you that in times of stress, people do want to be in the US dollar. But all things being equal, the dollar is going to go lower, okay? And the euro is going to go higher. Now, if we come over here and we look at metals and gold, gold is dead money right now. Look at what gold did on Friday. It's down 42 points. Right in this area here, when I thought we would get a breakout in gold and it triggered, we never did make that prior pivot high, and it rolled over, and it's just not been able to get outside of its own way, and it was just ugly. Okay, ugly, ugly. Silver's performing a little bit better, but it also had a bad day too. Notice we've broken the downsloping trend line with silver, and we're trying to get some escape velocity, but we just can't. They kind of they don't get too far out of whack. But right now, silver is way outperforming gold. So just from a contrarian standpoint, everybody wants to be short gold. So I think a bounce back to this trend line could be kind of an interesting contrarian play in gold. But our play is nowhere near precious metals right now. It's just not. Our play is more in the industrial side. When you've got the markets that we're getting, industrial metals is where you want to be, and you could see copper. Now, a little bit of a pullback would just allow people to load up on copper futures, or in Freeport McMoran. This is a trade that we got into way back over here in the first, or I think it was the end of the first week of April. Copper futures was where we wanted to be, and it's just been a great trade. You can see the trend line. It's just almost using this as a regression trend line where it's going both up and down, but it gives you the vector, the upside vector of this thing. Now, it got ahead of itself in early February. It's going to pull back a little bit, consolidate, and then it's going to begin the run again. So for our members, we'll call this thing out and we'll play it. Let's take a look at oil. If we look at the oil markets, again, a little bit ahead of itself, but very strong. In fact, every time I look at this damn thing, I got to raise the high price. Look at that move off my solid support point there. So we've been playing oil using ratio condors and iron condors, and just changing the spread between the puts and the calls, as well as the quantity and the count that allows us to manage better upside maneuvers, because that's just where oil is going right now. Now in March, we're going to get OPEC meeting, and I think there's word that they're going to increase production. They don't want to get oil too high because it's going to cut down on the buyers. But a big part of the oil movement has been inflation. Look at oil going up. Now, the other one that we've been interested in and looking at really strong is gasoline futures. Okay. And if we look at gas futures, you can see here, it is just through the roof as well. Both of these trades, and I was calling them out, and there's different ways to trade gasoline futures, but just look at the movement. I mean, it's just, folks, if you don't think that's going to add to consumer spending, oil and gasoline, then you're living in a cave or you're driving a Tesla. But it's going to affect a lot of people. Even the components and the parts that go into making a Tesla, you use energy in the manufacturing process to do this. So it's just going to be very expensive in doing this. Excuse me. Nat gas, well, nat gas, as you guys heard me say, up in this area here, it's a sell. You want to sell nat gas, I don't see it holding that price very long. Look at corn, wheat, and soybeans. Corn is higher, all right? Look at soybeans. Soybeans, higher. Look at wheat, more choppy, but higher. So the ag market, all of them are higher, all right? Higher, higher, higher. Look at cattle futures, higher. Look at lean hogs, even though it's pulling back, higher, right? Now we got a when pigs fly trade, which means when they get too high, we want to short them. But when you got the meat markets going up, you got the ag markets going up, you got the energy markets going up, you want to be long commodities. Now, members, we got ways to play that, but commodity plays are going to be good this year. All right, they're low-hanging fruit trade, and as you guys know, we love our low-hanging fruit trades. A lot of ways to play them. All right, everybody, that's kind of my quick update for this weekend. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. Whether you're an options trader, you want to play stocks and options around them, or ETFs, or you want to trade thematic plays, whether you want to play DNA sequencing, robotics, energy storage and use, electrification, artificial intelligence, blockchain, all of these things. There's great themes that we can play, that we are playing, that we use options around them, and maybe a combination of ETFs or stock, equities, or in the futures and commodities market. Just a lot of great plays out there, guys. Remember, even though the market may be crashing in one area of the markets, other areas it's going very well. So members, I will see you tomorrow evening. If you're a non-member, check us out. If not, I will see you for our next weekly roundup the following week. Have a great weekend, everybody. Ciao now.